Okay. Well, good afternoon, gang. It's another Friday, and here we are with the three consulting amigos. And today we're going to rely very heavily on the CPA of our team, Ed Lasak, who's going to go over why and how you should invest in your business internally to be able to increase the multiples in your business as you exit. And you're in for a treat. It's a high level, but Ed's so good about breaking things down. I think you're going to find this very valuable. So having said that, Ed, take it away.
Well, today's program, we're going to talk about one of the 8 drivers and of optimizing a business, and that is to invest in high rate of return, ROI, projects of your company. But before I get into the specifics, I'd just like to talk a few minutes about the 4 steps, remind everybody the 4 steps of the exit planning. And the first one is to select an exit strategy. The second one is to optimize 8 value drivers. And we're spending a lot of time talking about the value drivers because this is how you increase the value of your business by having more cash flow as well as increasing the sales multiple. The third step of exit planning is a succession plan, which we're going to talk a lot more in future sessions about. It's really important that the business run without the owner, and most businesses don't. So that's quite a transition that one has to make. And then also, once you prepare a plan, you need to begin selling now. And it's like a 3-year process, but selling now is really important. And then we talk a little bit, and we've been talking a lot about the 8 drivers of value of a business.
Do you mind explaining to us a little bit on why it's so important, that last one, start selling now? Explain to us from your experience why that is so important.
Well, you have to begin telling your story. Last week we talked a lot about how to differentiate your company from others. Okay. Your competitors, so it has a greater value. But you also have to go out and start meeting people that are potentially interested in buying your business. And those relationships, and selling in business is always based on relationships. Right. Beginning those relationships early in the process is extremely important. So you may have lunch with somebody and start talking a little bit about your company, and then you plant a seed in his head or her head as to what they may be interested down the road in buying your business. Right. So that's what I'm talking about. And plus, there's a lot of due diligence that you have to start doing now to begin selling your business. You just don't put a sign on your business like you sell real estate. It's a 3-year process.
In marketing, they call that a long lead time. And so when you're selling a big building, you don't plan on selling that in 30 days or 2 weeks. You have to do a lot of work ahead of time to do that. And just like large equipment, $1 million pieces of equipment don't get sold in 30 days or 2 weeks. So we're talking about businesses that need that as well. And I would say the other side of it is that the market of selling businesses is a tough market. It's tough in the sense that not very many people get their businesses sold. So you have a lot of businesses for sale and not very many buyers. So that takes even more time. So yeah, 3 years is easily within the bounds.
Yes. Okay, we'll move along here to the 8 drivers of value. And today we're going to be talking about the 5th one. It's way at the bottom. It's invest in high return on investment projects. And it starts kind of like this. I really don't know. This is based on my 40 years of experience. This is what I've learned. People don't really like to spend money on investments. And everywhere I've really worked, I've gone in and identified a lot of opportunities by looking at the way you're doing business. And you find out a lot of times they're using old, decrepit machines. I was running a labeling operation at one point in time in my career. And we used to do labels on the weekend. And we were using machines that were like 40 years old. And they had like 1 or 2 maintenance guys fully dedicated to these machines to work on them Monday through Friday so that they could perform Saturday and Sunday. And that was normal business. And when I went to them and said, well, we need to upgrade these machines, the new technology, and these are the advantages we're going to get. And it had like a 30 to 40% ROI on it, made a lot of sense. But for whatever reason, there is kind of a subculture in business not to spend money. Another problem with investing is that the CEO will come in and say, I want to buy this equipment. And there's no analysis performed. There's no potential ROI. It's just based on a whim. And by the way, 3 months from now, that same CEO could come in and say, I want to buy something different.
Yep.
So you got to have a more systematic approach to evaluating these opportunities.
Ed, can you put your mouse on where you're talking about so we can follow along?
I'm starting right here.
Okay, thank you. That helps.
So those are two things you have to deal with, and very few people take the time to get their management team together and go through their operations and identify things that you need to look at that could provide a return on the investment that you are going to put forward. So anything that increases profits and cash flow, you got to think about it and you got to do it. You got to put it on the list. Anything that strengthens the balance sheet is extremely important. And after you have all this input, you may have 20 to 25 different projects. Then you've got to do something really, really important, and that is to prioritize these projects. If something's earning 5%, it's going to be towards the bottom of the list. If you come up with something that's going to bring in a 75% return on investment, that's going to be on top of the list. And there has to be a systematic way of evaluating projects. And the one that's mentioned in finance books is called the discounted cash flow rate of return. And this is where you use present value numbers and you project your savings over a period of time, and you come up with a return on investment and a net present value. And from that, it tells you how much that investment will add to your bottom line. So once you have all that information prepared, you want to sit down and you want to prepare a 3-year capital plan for your business. And in these capital expenditures that you're planning to make, it's not only the ones that bring in an ROI, a high ROI, but it's also the ones that are requirements of doing business. So something could change from the government standpoint and some type of regulation, and you got to make sure that you build that improvement into your capital plan so you get it done so you can stay legal and still continue doing business. So and another thing is every so many years you got to put a new roof on your business. Those don't provide an ROI, but they're necessary for you to do business without having a bunch of leaks in your operation. The other thing you got to look at in these capital items is redundancy and backup. Extremely important to support your business continuity plan. No matter what type of operation you have to have a backup if something doesn't work right. And if you don't operate with backups, your business is at great risk of not meeting the expectations of your customers. So that's also very important. When it comes to improving the operation and having a high ROI, you improve customer experience and analytics is extremely important. Anything that increases top line revenue. And obviously you want to improve the gross profit margin and you want to reduce fixed expenses. All those items there will result in a return on investment that's important for your investment to make sense. And then the last thing, well, excuse me.
Do you mind if I ask a question there?
Sure.
You know, I've seen you do this, and you know, as a small business owner who who would you recommend they reach out to be able to help them put this together? Because it might be beyond the skills of the CEO. Would it be another CPA like yourself, or how would you recommend they go ahead and do this? Because it's extremely important.
Well, you have to have someone who understands how to run a business. And that's the highest knowledge priority that you need, because you really have to sit down. It's like strategic planning. You have to get the top people involved in the corporation, and you have to sit down and think about opportunities for improving the operation. So you really need an operational type of person that's going to help bring these opportunities to the surface.
And I would suggest that, many of these calculations are not terribly difficult to do, but you might not be able just to sit down and decide to do it. An average business owner wouldn't know what to do. But if you have someone come in and help you put together a spreadsheet, and you're looking at 3 pieces of machinery, and you'd like to be able to calculate the best return on investment, that's something that you could have a template put together. You could have Ed do it. You could have a CPA do it, and then you literally calc it all out, and you just the answers would sort of pop out. Correct me if I'm wrong about that, Ed.
No, I think this is an excellent question, because it's a 2-part process. The most important part is to identify the projects.
Yeah.
And that's where you need your operational experience. Once you identify the projects, then it's just filling out a spreadsheet based upon the advantages that these investments have to your operation. So you need an operational guy to identify the opportunities, and you need some financial experience to be able to do the calculations. But as you'll see, I got a model attached here. The models are pretty easy to do. And you just fill in the information, put in your tax rate and assumptions, and you'll come up with the right answer that is necessary for you to prioritize the project.
Cool.
Good question, by the way, guys. The last part of any good capital plan, and it's very often not dealt with, and that is, okay, where are you going to get the money to buy all this stuff? So you got to do that concurrently with your planning, so that you make sure you have that cash at a decent interest rate when you're ready to make the investment. And I have a couple items listed here that you should look at. And one of them is to reduce working capital. And that's basically do a better job of collecting your receivables, keeping your inventories down, and not paying your bills too frequently, or just frequently enough. And that, believe it or not, a lot of times frees up a lot of cash that you could invest in some type of opportunity that could bring additional profits to your business. The other thing is you start talking to your banker when you don't need money, so that you can drive the best bargain and with the lowest interest rate, the best payback terms possible. And that way, again, you have flexibility of spending this money when you need it. And you can go down and write the check, and you're in business, rather than, well, we're thinking about doing this, and then 4 months later, you may get an answer that you can or can't do it. That's not a smart way of doing business. And the last thing on this list here, and I want to spend a little bit more time on it a little later on in the program, and that is better understanding your cost of capital. If you can finance something completely out of debt, your rate of return is going to be significantly better, because interest rates now are very, very low. But when it comes to owner's equity, believe it or not, most owner's equity, most people are expecting a 20% return on their equity. And we'll talk a little bit more about that down the road. Don't run away, please. This is kind of a snippet of the evaluation of every project that you will do. And basically, once you have this format, this template, you put your information in, and it'll crank out the an evaluation for you as to what your internal rate of return is, and also what your net present value is for every investment that you would be looking at. In this situation, I'm looking at an investment of $100,000, and with that $100,000, I'm going to have increased profits of about $41,000 a year. And at the end of it, it's going to guarantee me a 15% rate of return, plus give me another $17,000 left over in net present value.
Do you mind, can you help us out a little bit here, Ed, and kind of point to where you're referring to? Because it's a great spreadsheet, but I have no idea. I'm trying to follow if you don't mind.
You bet. So I'm going to move your picture out of the way so I can see the numbers. In this situation, we'll look at year number one, and year number one, we have an opportunity to make an investment that's going to increase our revenue by $50,000 a year.
Okay, got it.
And we're going to have increased expenses for that $50,000 of $10,000, so we're going to net $40,000.
Got it. Okay.
And this investment's going to also reduce some other miscellaneous operating expenses of $1,000. So we're going to have increased profits to the bottom line of $41,000 a year for 5 years. And you have to pay taxes after you get your depreciation deduction. So in this situation here, for that $41,000 in the first year, we're going to have to pay $8,400 in taxes.
Okay.
So we're going to net a cash flow of $32,600 after we pay the tax man. And so as you can see, it's $36,600 the first year, and the last year it's $29,208. Total cash flow of $160,000. And then we discount it based upon present value rates at 15%, because that's our cost of capital, which
Right.
we'll put in a little bit more later on. And you'll see the discounted cash flow is going to be lower than the net cash flow because of the discount factor. So the $160,000, we're going to net present value in today's dollar terms of $116,000. The difference between those numbers is interest that you'll be paying on the use of that money.
And why are you using 15% in this example, Ed?
Well, that's a very good question, and I appreciate you asking that, because that is our weighted cost of capital. And this is going to be pretty much the case for most small businesses. But in this situation, I'm assuming that we're going to use 30% of the $100,000 is going to come from debt. And debt is, I can borrow money now from the bank at 6%. We get a tax write-off of that. So the effective rate of debt is 3.6%. Weighted at 30%, that's like 1% for my weighted average cost of capital. On the equity part, I'm saying that most small businesses, owners of small businesses, would want a 20% return on their investment for small businesses. And it's based on this, basically. You can invest money in the stock market believe it or not, at far less risk and earn 12% on average, so you're asking for like an 8% premium to invest in a small business rather than in the stock market.
And and many businesses are doing much better than that on their current assets. So that's not to a person who's not involved in business. 20% might sound like an usury or something, but that is not an outrageous expectation, is it?
No, actually, Ron, I think it's pretty modest. It can get as high as 25, 26, 28.
Yeah.
And the reason being is that these small businesses have a tremendous amount of risk.
Right.
A big corporation can absorb a crisis or two or some challenges at different parts of its market or some of its products and still be able to move on. But when you're in one little place, one little geography, and you have a problem and a hiccup and you don't have any diversification, your business can be significantly disadvantaged.
Well,
Right.
COVID has proven the immense amount of unexpected risk that is possible. But so yeah, I always build my models on 50% because most of my businesses yielded about that.
Well, I think you're a good businessman. If you can get 50% on any investment, you should jump on it right away, as far as I'm concerned.
Well, they were mostly, with the exception of the retail business, they were mostly investments in people and software. So it's not like I've never owned a factory, so it's not fair to say everybody should be looking at that. But when you're doing internet business and that kind of stuff,
Right.
it's not unusual to be able to get extraordinary returns. However, that's many times that's offset by the fact that there's not a giant market, and you're not going to be able to go out and add $1 million of business just by making a small investment, that kind of thing. But I have the times that I have gone through this with clients, just thumbnail, not at all to this degree. I found that most of the ones that were successful were getting 30, 40, 50, up to 70% return on a new investment. So
I think it's worthwhile for any business to know what their weighted cost of capital is.
yeah, no, it's very valuable, I think.
And it really shows if you can invest something truly out of debt and not put the company at risk. Look at the difference
Yeah.
in the rate, 3.6% compared to 20%. That's a no-brainer.
Yeah.
But as you can see, we weighted 30% debt, 70% equity, and we come up with a rate of 15%.
Yeah.
So I guess the next question could be, why is there such a difference between the rate of the debt compared to the rate of the equity? And that's the question you raised, Ron. Saying 20% to most people would seem very high. But here's the justification for it in the next slide. This here is how you calculate the equity rate. And it's called a build-up method. And it has different tranches of risk that you add up to come up with your expected equity rate of return. So as you can see, in the first one here is risk-free rate, which is 20-year government securities. They bring in about 2.5%. That's what most people would say is the least risky investment you can make on your money.
Yeah, that's good. It's a good slide.
And then the next tranche is called market premium. It's sort of like the stock market. Over time, it's going to earn about 11%. So, and people think the stock market has a lot of risk.
Right.
But it's nothing compared to the risk of a small business.
That's true. Absolutely.
And then the next tranche is called a size premium. And this is based upon the size of a company. And there's analysis that's been done by this outfit called Duff and Phelps. And they have looked at these different risk levels and investment requirements from the really big companies compared to the very small companies for companies that have sold in the stock market. And the size premium alone could represent 5.8%, almost 6%. And then I put down a company-specific risk premium of 3%. And honestly, you could go anywhere from 3 to 10% based upon the riskiness of the business in question. So that pretty much concludes my summary of investing in high rate of return projects for a business. Again, I think it's an opportunity that a lot of business owners fail to take a look at. And I think it's really low-hanging fruit. It'll make your business run more effectively, and you will make more money and have less risk. I think it's definitely one of the 8 value drivers that makes a difference when you're getting ready to sell your business, or even if you're going to keep your business, you'll make more money.
Yeah.
Ed, if you can, and Ron may have this or similar question, can you walk us through an example of, let's say, equipment versus, let's say, an investment in a new marketing program, as an example? And they're very different, but how do you evaluate that? Because basically what you're telling us here is that if the company has done an effective job of listing their priorities in terms of what they are, the numbers should validate which is the most significant in terms of return on investment. Is that fair?
That's a fair question, and that's a very good question, because you're talking about an investment in equipment versus an investment in top line.
Right.
And all these investments that are out there require some study as to what they can do to your business. So if you buy some new equipment, your people can pretty easily determine what kind of return you're going to get on that equipment. So let's say maybe you can process 50% more work in the same amount of time.
Wow. Yeah. There's your productivity.
That's a big savings.
Yeah. Yeah.
Whereas on the marketing side and the top revenue side, maybe it's opening up a new market, and maybe those estimates of value of improvement are a little bit more subjective, but I think you can put a pencil to them, and you come up with assumptions, and from that you can kind of determine the risk of investing in a piece of equipment or starting in a new market, or whatever the top line revenue would be. Having better information on your customers means a lot.
Yeah.
I'm doing something similar right now for a new advertising program that would include buying some traditional media. Those can be very subjective, but if the company is sophisticated enough to be able to identify where the leads come from and then value those as closed business, you can build a kind of a trail and get to an estimate. So we've done trials already and found that we were able to lower the cost per new customer to a little bit less than what it costs to sell a salesperson, for a salesperson to sell it directly. And so that was good enough for us to think about expanding that program 5 or 6 times. So currently what we're doing is we're taking a look at the reach and what the cost of each spot would be, each channel / media, whatever it's going to be. And then we can compare them using this method. It's not this sophisticated, but in terms of just sort of top line numbers, how much new business can we develop and how much does it cost? And the threshold in this particular case is we know what it costs for a new customer with a salesperson. So anything that is less than that is money that is saved, and that money goes directly to the bottom line because there's no variable cost associated with that.
Well, I think one of the things that knowing how you've worked inside that business, Ron, you have collected data for decades, and what I think what would be valuable for Ed to kind of touch on here is, we're dealing with some companies that may or may not have ever even considered this, and now they're saying, oh my God, this is a great idea. Could you kind of walk us through the categories of projects that you think would be good to put on this list? And then at the end of the year or at the end of a quarter, whatever that is, would you recommend they reevaluate them again to see whether the return is what they're anticipating? How would you help them proceed?
Well, I think.
Go ahead. That's a question for Ed, right?
Yes, yes.
I think there's a couple different components of this. I think every year you update your capital plan. And some projects may drop off and some new projects may emerge, and you adjust it accordingly. And you can't do everything at once. So you have, one of the toughest things is prioritizing what you do first.
Right.
And sometimes you may have to do something, spend some money on a capital item for regulatory compliance, and you have to forego a year or so on something that's really going to add to your bottom line.
Right.
But I think it's really important that once you approve a project that has an return on investment, it's extremely important to do an evaluation at the end of the project on how well you did in meeting those requirements, those expectations. That'll make your management team much more knowledgeable and accountable, and it will help you in future projects. So you justify the project up front, and then you do a post-implementation valuation at the end, and you can determine how good your management team is. And so anyway, I don't know if I've answered your question, Ray, but that was my attempt.
No, that was good. I think, because I'm such a neophyte to this, the question from my perspective is basically, let's say I've got a business with 20 employees. Would I be a good fit for this? Or let's say I've got a business with 4 employees. Are these things valid for both businesses or more valid for one than the other?
They're valuable to all businesses.
Yeah, any business over
important ingredient to all businesses. You need to have this stuff in place if you want to improve your business.
And I would say that businesses with one person kind of do this thumbnail. At least I should say the successful ones. There are a lot of business people that just are small but they're savvy about numbers. And they simply, will go through and say, okay, I'm going to spend X amount of dollars on this machine, and what am I going to get out of it? And so, they kind of do a little bit of this anyway. But where I think Ed's point is so valid is that for a little bit more complex business that can compare 3 or 4 or 10 or 20 investments, it's really nice to be able to delineate down and say, boy, I mean, there's a better chance here.
Right.
Of getting the return on this kind of investment and this kind of investment. So I would, it's unfortunate, but the businesses that survive do some of this some way, even if it's seat of the pants. The ones that survive and grow, so many times statistically, you make it past market acceptance, 1, 2, 3 years. And then as you grow towards that 5 years, they go broke in a little bit higher number. And that's because they got too big and didn't know how to run it. And so there is that place where you have to have some business technique and technical understanding in order to be able to make the right decisions. Because those decisions that the successes of those businesses that have made it the first 5 years or 3 to 5 years, really they die based on a succession of poor decisions, because the customers like what they're doing. They're in business. They've managed to get top line to a place where they're doing some volume. And now if they don't make any money, or if they're not making enough money, or if they're not growing fast enough, or if their expenses, are outstripping their growth, those are all business decisions that were poorly made. And so they end up going out of business because they didn't have the savvy to be able to do that. And it sounds a little bit harsh, but I think that's reality. And
if I can add this dimension to it, we're aware that if there's anybody in a business currently today, like the 3 of us, and it's a small business, 80% of those guys are going to go, or gals, are going to go out of business in the next decade because they really didn't ever create a business. What they created is this glorified job. And its purpose was simply to satisfy their lifestyle. And in doing that, it did a lot. But the statistics are real. Only 20% of businesses ever sell. The rest of them just go away.
That's right.
And, part of what I think is valuable about this, Ed, is that, imagine there's just 2 or 3 out of 20 people that listen to this particular broadcast and are able to say, wow, I think I could do this. It could have a huge impact on them down the road. Or as Ron knows, we've got all these little micro giants out there. And what he's referring to are young people who are looking for an opportunity. And we know they can start their own business if they want. But the possibility of surviving over the first 5 years are about 20%. Whereas, getting Ed's business or Ron's business or my business gives them a leg up that they otherwise wouldn't have. And so to me, being able to help them understand what you're talking about, makes a huge difference in terms of their quote survivability.
Yeah.
Absolutely.
I also thought I would just mention that sometimes these investment decisions are part of how you do grow, because so many times you can't do more business because you don't have the physical ability to do so.
Right.
That could be literally physical, or it could be a bit
Yeah.
plant size or machinery or whatever it might be. Now, on the internet, yes, a lot of things are more scalable than they used to be, but you still have to figure out how to ship things and so forth. So there are always those issues. And so a lot of times you need to make this evaluation first and invest first before you grow. It's not like making an advertising decision. It's like, so ratcheting this up is one of the more difficult things to do, I have found. And that is that if you buy a laser engraving machine and I've got a friend who does this, and he does original artwork on wood, and they're gorgeous, but it takes a certain amount of time to do that. And fortunately, he's been successful. Well, what happens is that he's got one machine. And so he can't grow at 20%, because if he's at capacity, he now has to buy a machine at 100% of what his first machine was. So he spent a bunch of money to get in business. And now from, at that point in time, he can't invest 20% more and get 20% more business. He has to invest 100% more of the machine to get 20% more business.
Right.
So this is a different calculation. And so that's an important part of this. Can he grow 20% for 4.5 or 5 years?
Right.
Well, okay, that's another discussion. And now we're back into the marketing side of forecasting. So, those are a lot of the pieces, but the very, very small folks are faced with, oh my gosh, I just paid off this $50,000 machine. And no one doesn't want to buy another machine. He's making money for the first time.
Yeah.
He doesn't want
And
to
Ron,
invest in another
you brought
$50,000
the machine example up, but it's also hiring an employee, right? If you hire an employee, your incremental costs have gone up dramatically. Is it really worth it for you to hire that employee? When do you make that decision? When do you pull the trigger to say, I'm going to bring somebody on?
Well, if in using the same example, you can hire an employee to come in 20% of the time to do the work, but you can't hire a machine to come in 20% of the time.
Yeah, true that. Yeah.
So that employee, if you're doing all the major work and you got your one new first employee, that employee is now a variable cost because you can control how many hours they work.
Yeah.
So they can deal with that. But it's and then you get to the point of, well, wait a minute, I've been doing this in my garage. I'm going to have to get a building. So you see, now you really have to look at the cost of the building and the cost of the machine.
Yeah.
You've got OSHA stuff to do if you hire the employee. So now you've got more and more and more.
Right,
and that's why it's so difficult for small businesses to grow. They have a good idea, they sell something, and what do they do now? Well, this is how you figure out how to prioritize, as Ed suggests. You have to figure out some methodology to prioritize what you do and when you do it.
Well, it's funny, and I don't know if you guys have seen this, but how many times I watch these small businesses go from the captain to the captive, right? They're a prisoner of their own business. They can't even get out because basically they're kind of trapped, and so they just keep going because what else am I going to do?
They're afraid to let go of the end of the python, so to speak.
Yeah.
the point that's also very important, it's item number 4 on the slide, is doing some
Can you point
cash.
to that for us, please?
Identify how to fund investments.
Okay, cool. Thank you.
That's extremely important to do now, which means you got to understand your cash flow and your borrowing ability with your banks, and do your negotiations on that and make your changes so that you have more cash flow, so that you are able to buy this equipment or invest in these opportunities when they come up. And a lot of times small businesses fail to do that. And they have an idea, they want to do something, but then they find out they don't have the wherewithal, the money to pull it off. So you got to be able to forecast cash flow also. And you got to work that balance sheet so that it's a asset to your company, a strength of your company, that you can move quickly on these opportunities when they become available. Because the one thing I've learned in business, especially when it comes to equipment and that, opportunities come up and they come up quickly, and people want the money now. And if you can't come up with the money, you lose out on a great investment.
That's right.
Right. I remember when we had the last recession, Warren Buffett said, when it's raining gold, you're out there with buckets, not with thimbles. But the point here in that the other side of that is the goal that he's talking about are these opportunities that come up, and they're only once in a lifetime, and you either take advantage of them then or they're gone. And part of what, if I understand what you helped us grasp here, Ed, is that with maybe 40 hours of work spread over an amount of time, you can create something like this for your own business, so you can actually grow without risking the entire business, and actually give yourself an opportunity to go beyond that captive state into, again, being the captain of your business.
Absolutely. Well said.
Yeah.
Well, having said that, Ron, you look like you're going to kind of wrap this up in some way. I was kind of waiting for you to say something.
Yeah, well, I had a couple of ideas as they came up. I think that I don't think are particularly relevant anymore because we have talked about them. But I will mention that we touched on this banking relationship only sort of secondhand by talking about getting your balance sheet in shape and having equity and that kind of thing. And I think that we'll need to have more discussion about the care and feeding of your banker because this is really important. I mean, if you can't fund this stuff, then the question is, well, why go through the exercise?
Right.
And so it's really important to think about where that's going to be. And one of the things I just was thinking about is, well, if you are trying to grow, we'll go back to the example of the guy who has the little laser printer, and if he says, well, I can do some of these manually, so I could hire somebody for 20 hours, or I could buy a machine, but that's $50,000. There are some differences there in terms of getting your balance sheet right. Now this is kind of in the form of a question, Ed. When you buy a machine, that goes on your balance sheet. So you may spend $50,000, and if you've got $20,000 in the machine, and of course there's depreciation, which we don't need to go into, but you've got something to put on your balance sheet which the banker likes. But if you are spending more money on labor, you've got an expense on your income statement which the banker does not like. So how do you balance those things when you're trying to figure all this growth out?
Well, you hit on another good point. I mean, the bottom line to any business plan is to make it better. And hiring a lot of people to do manual work and dig the ditch a certain way every day doesn't seem to make a lot of sense. I'd rather buy a piece of equipment that figures out a way to dig the ditch in half the time with half the people necessary to run the machines.
Yeah.
So you got to constantly be looking for these opportunities. And this is where culture really becomes important. If your culture is to be inclusive and transparent with your managers and meet with them frequently and have communications, these opportunities come up frequently. Whereas if you're an owner and you have all the answers and you don't need your direct reports to give you any information, you kind of go in and tell them, well, we're going to buy equipment A today. You're missing a great opportunity. And I think we kind of get into the Ray's world of good-hearted leadership by managing in that way.
Yeah, and what I was hoping, can you back up to the 8 drivers here as we wrap
Yes.
this up? I think Ron, you kind of set the table for us there by telling us that maybe the next session should be about the care and feeding of a banker to be able to help you move forward. Which of the drivers would that specifically go to? Would that be investigate M&A or partnership opportunities?
That would be optimize your balance sheet and cash flow.
Cool.
Yeah, right. Yeah.
All right. So having said that, I think that's wonderful. Ed, great job. I think it helped me tremendously. And I think as we move forward, we're really giving people an opportunity to see how even in a small business, and what I mean by that, somebody with 5 or fewer employees with the right resources and the right people, they can in fact break through these barriers that hurt so many people. And we can save a lot of these 80% that will in the next decade simply close their doors. So, and unless anybody, you have anything you want to close on, Ron, before I pass it on to Ed for a
That was
final
my closing question right there.
Well, good. Ed, thank you so much. I think this was very enlightening, and I really look forward to the next session, which will be talking about how we can optimize the balance sheet. So with that, thank you guys. Appreciate it.
Bye.
Cool.
Not yet.
Good job.